You've saved $1 million and you're trying to figure out if you have enough to be able to retire. In this video, I want to show you how you can run that scenario for yourself to determine if you've saved enough, if you're going to be okay, if you have enough resources to make it to the end of your life. And so if you're ready, let's dive in. We'll use the retirement budget calculator to do just a real simple scenario here. Okay, we're in the retirement budget calculator. You'll notice their net worth is $1,450,000. That consists of $1 million that's liquid in things like 401ks, savings accounts, brokerage accounts, IRAs, those types of assets. And then they have real estate valued at $450,000, and they have no liabilities. Everything's paid off. So the first thing we're going to do is we're going to come to the time tab. You'll notice John and Nancy. He's 60, she's 60. They plan to retire on December 31st of 2025, and they're planning to start their Social Security right when they turn 62. Then we look at their assets and liabilities. They have a savings account with $200,000, a joint brokerage account with $200,000, and a traditional IRA with $600,000. And then they have their primary residence here valued at $450,000. So you add all of that up and they have $1,450,000 as their net worth. The next thing we want to do is look at their income and expenses. So for income, right now he has wages. He makes about $10,000 per month, and that's going to end when he retires. They're both going to start their Social Security at 62. His is going to be $2,200 a month. Hers is going to be $1,200 per month. And then he's also going to have a pension of $1,000 per month. So that's all of the guaranteed income that they're going to have. We're going to assume that the cost of living adjustments on Social Security are lower going forward than they have been historically. So we'll assume just a 2% growth rate there, where they've actually been more closer to a little more than 3% per year. But we'll just assume 2% to be conservative. And then for expenses, now you know the reason we created the retirement budget calculator is because this whole exercise about whether or not you have enough is based on your spending. But just to keep this as simple as possible, we just created an expense and just put all their expenses, lumped them all together, and said they have $7,400 per month is how much they want to be able to spend in retirement. Now, of course, we're going to be automatically calculating their federal income taxes every year. But if we come over to the future view, here's what I want to show you. Over on the assets and liabilities page, you notice I'm assuming their savings account is growing at 2%, their joint brokerage account is 4%, and their IRA is growing at 4%. And I'll show you how we can play around with those numbers here in just a minute. But so you can see right now they have plenty of income coming in. Their income's greater than their expenses, and so they're running a surplus initially. The green line represents the year of retirement. If we look at the year 2026, they'll have started Social Security, but it won't be a full year of Social Security. So his Social Security, her Social Security, and then a full year of the pension at $1,000 per month. So they're going to have $42,000 of income the first year. Their expenses require $94,207, and you'll notice those expenses are going up every year with inflation. We're assuming 3% inflation. So they have $42,000 of net income. They have a shortfall of $51,619. A shortfall means that they have income of $42,000, but they're spending $94,000. So this $51,000's got to come from somewhere. In this case, we're just assuming that they're taking it out of the savings account. So you can see the savings account grows at 2% per year. They take the withdrawal, and at the end of the year, they have $159,000 remaining. In 2027, at age 63, now all of their Social Security is kicked in plus the pension. Their income is $55,000, and their expenses require $97,000. Now you might be saying, why aren't they paying any estimated taxes at this point? Well, the reason for this, if we were to go over to the tax tab and we look at the year 2027, they have pensions and annuities of $12,000, and they have Social Security of $43,297. But the provisional income rules show us that only 1.91% of that Social Security income is actually taxable to them, $825. So the reason for this is because they're pulling all of those portfolio withdrawals out of the savings account initially instead of the IRA. Now we could change that. We could come over here to the assets and liabilities, make his IRA the first account we dip into, and then come back over and look at the tax tab and see. Now that significantly changes the amount of taxes they're paying initially, because Now they're taking those IRA distributions, they've got this tax, and 85% of their Social Security is taxable. So this is one of those levers that you can play around with to see what's going to make the most sense for you. We'll switch it back to just the default withdrawal order and come back to our projection. So you can see they've got $1 million. It's growing at basically 2%. Well, we've got a variable rate of return here, 2% on savings, 4% on the joint brokerage and the IRA account. So that first year of retirement, they have a 4.8% withdrawal rate, and that's because they don't have all of their Social Security kicked in. The second year of retirement, their withdrawal rate is 3.9%, and then the fourth year of retirement, their withdrawal rate is 4.1%. So we're going to just project these numbers down, and you can see that their money's growing at 3% per year, or their expenses are growing at 3% per year. Their portfolio withdrawals are having to increase every year. When they get down to age 75, the required minimum distributions are going to kick in, so that's money that's going to have to come out. And you can see in this model, as making these very conservative assumptions, we get them down. He's age 82 at his life expectancy, that's when he dies. And her life expectancy is age 85. So you can see at this point they have depleted all of their resources. That $1 million that they've saved has been depleted by his age 83. Now the good news is they still have a house, and that house has been appreciating in value. So at this point she could take a reverse mortgage if she needed to. She could sell the house and downsize and move into some kind of senior living complex. But the point is they've used up all of their liquid investable assets. Now, again, remember, that's assuming 2% growth on savings and 4% on the brokerage account. If we change this and we say ignore custom rates of return and assume all of their money is just growing at a simple 4% per year, we run those numbers again. Similar outcome, so age 82, the money runs out at age 83. And then we could say, what if we got a 5% rate of return? 5%. Now we get her all the way down to her life expectancy, and you can see there's still $123,000 remaining. So those are some of the numbers you can play with. It can help you identify what's the rate of return you need your money to earn to be able to keep up with inflation and to make it all the way to your lifetime, your life expectancy. A couple of other things you could play with. Maybe you're curious to know if you had 60% stocks, 40% bonds, and a historical sequence of return that was favorable starting in 1978, projecting that forward, just using the S&P 500 and 10-year treasuries to backtest an asset allocation, you can see they end up with a lot of money in that scenario. Or we could say, what if they had a bad timing sequence of returns? So this would be like retiring in the year 2000, where you experienced the dot-com bubble and then the financial crisis. And so in this model, you can see still we get them all the way down to her age 85 with a bad timing sequence of returns. And so that looks pretty good. Another thing you might want to do is change the life expectancy. So we just start out by assuming Social Security mortality tables. We say, based on Social Security, he's going to make it to age 82 and she's going to make it to age 85. But maybe in their family, everybody lives to age 90. So we can come down here and make a hereditary adjustment, go back over to the future view, and then look to see how we would have done under that kind of scenario. And you can see if we increase the life expectancy to age 90, now we have them running out of money basically at age 88, assuming this 60-40 stock bond portfolio with a bad timing sequence of returns. If we go back to just a simple growth rate, assume that 5% rate of return, we do get them all the way down to age 87 before they've depleted the resources. The thing I want you to take away from this is you can enter into retirement with a lot of confidence. The number that really drives the equation as to whether or not you're going to be okay, it really has everything to do with your spending and less to do. You obviously have to have resources to draw from, but if we don't know how much money you spend, it's impossible to be able to answer the question of if you're going to be okay. And that's what the retirement budget calculator does. It helps you say, okay, you've saved $1 million for retirement, or 1.2 million, or 1.5 million, or 600,000, whatever that number is for you. You compare it to what your expenses are, and the calculator can help you understand whether or not you've saved enough to be able to last for the rest of your lifetime. I hope you found this helpful. Thanks so much.